Okay, let's kick it off. Let's have some fun. So as I said in the opening, there is a couple of spots where we will stop for questions. If I can ask you to hold microphone questions until then, feel free during the session to use the chat window and put your questions into there. I will try to make it as interactive as I can. I'm a fairly lively presenter, I'm told. So whatever that means, yeah, all good. All right, can you just give me a thumbs up or some sort of response that you can see the presentation on your screens, please? That will also get everybody to find the chat button, and hopefully that works. Looking. Hello, Ziga and Nino. You know where the chat button is for sure. If you can give me a thumbs up. Excellent. We know Ziga and Nino for a long time. They've been clients of ours for quite a while. So it's good to see you back at the webinar series. It's fun. Thank you, Jovi. Forgive me if I don't pronounce your names 100% correct. With a name like Uwe, I understand the difficulties. All right, let's kick this off. Successful property investment in 5 easy steps. First, a bit of housekeeping. We are obviously on virtual sessions, so technology sometimes hinders us a bit, so be patient if something happens that is unexpected. Please keep your camera and microphone off until the Q&A. I will stop a couple of times. Any questions are welcome. Put them into the chat. We're happy to email the recording to the webinar to you, so you don't need to write everything down. You'll get the full slideshow and the recording. Thanks for joining in. I'll do my level best to give you great content, great value, and your interest is much appreciated. Okay, as to the disclaimer, this information is provided in the presentation is in general in nature and does not take into account your specific circumstances. Makes sense. The lawyers want me to make sure that everybody is doing their own due diligence. So please talk to your own advisors and check with them before you make any investment decision. Everything that I talk about is gained from over 20 years of experience. So, and we have one old adage in our company, only what's good enough for ourselves is good enough for the team. So we take that very seriously, and we take it very serious that we understand we're playing with big amounts of money here. And usually one of the biggest investments that we do in our life, certainly to start off with. Okay, as to the agenda, I've promised to look at strategy, cash flow versus capital growth properties. I've promised to look at the area selection. How does that work? How do we select areas? The optimization and acceleration of results. We'll go through a case study and what is our suggested investment game plan. Sounds okay? I trust it is, otherwise you'll unscreen. All right, so first up, who is Property Friends? Well, we provide solutions for people aspiring to financial independence, choices in retirement, or leaving a legacy. Those are the 3 things that we find people come to us for. And really, property investment is just the vehicle. It happens to be the vehicle that I think is one of the risk-averse ones and one of the most predictable ones. But that's for everybody to themselves to decide. We've been in business for 20 years. And a couple of statistics that I'm very proud of. 92% of our business is by referral. Huge. 76% of our business is return clients. Huge. So that if I pat myself on my own back, no, that's not what it's all about. But that means that we're doing the things right and the right thing. We have a 7-step system that provides accurate, unbiased investment guidance. We provide training and opportunities, so we do deals and we mitigate risk. I believe in full disclosure, so we get paid by yourselves. Let's get that clear, because that, I think, is one of the biggest bugbears that I've got in the property investment industry. And I'm very old-fashioned. I don't mind admitting that. Ultimately, we serve who we get paid by. Now, I think it's a hell of a conflict of interest if I, as a property investment advisor or buyer's advocate, whatever you want to call me, get paid by the developer or the builder. Especially if you, the client, can't see what that figure is. So we have made the decision 20 years ago, we want to put the cards on the table. Everybody can and should know what we are getting per deal for the service that we provide. Now, let's get that out of the way, straight away. The typical fee, and I'm a channel partner, we are channel partners for Metricon. What you don't see is that Metricon has $33,000, including GST, included in your price for the buyer's advocate. Now, personally, I think that's not only hilarious, it's also highway robbery. That's much too high of a figure. But since you don't see it as a client normally, nobody worries about it. We think that's wrong, so we have a separate fee for service of $22,000, including GST. I know that's very low, but we keep our fees low by intent, because we think that if we can put money in your pocket at the end of the day, if the deal has got an upside for you, that's the way we want to start our relationship. And we are, quite frankly, into long-term relationships. So that's what the full disclosure and the separation is all about. We don't get any cent from any of the client partners, from the builder, from the developers, from the rental manager, whatever. And if you've got any questions about that, go into our website, check the, I don't know, 30 or 40 video testimonials and 50 or whatever written testimonials that all have names, numbers, and so on and so forth. Thank you, Lenny. Lenny has just put the link to our website into the chat messages. So by all means, and quite frankly, I don't think you can do what we're doing for 20 years without a bad mark in the almighty Google. So you can look for references in there as well. We're very proud to be an ethical business. All right, enough of patting myself. As to the strategy, and that is where everything should begin. Because the biggest challenge that I have and that I see around the traps is 86% of people end up in retirement either dead broke, dead tired, or just dead. One of those three options. Now, I'm sure we can agree that neither of those three options is very desirable. So, if we don't want to be like the 86%, we got to be doing something different. And that something different depends on what do you want to achieve? Where do you want to end up? So for that, we need to establish a baseline. We need to know if we want to go anywhere, we need to know where we are at. Makes sense, doesn't it? So we need to know what is our, and now I can use big terms, profit and loss, what is our balance sheet and our cash flow? Let's make it easy. We need to know what income we have got and what expenses we've got. And if our expenses per month or per year are higher than our income, We better know that now, because that's a big problem. Same thing, balance sheet. What do we owe versus what do we own? And if we owe more than we own, that's a big problem. We better know now. So, you know, it's not rocket science. Sorry. At the same time, we need to know our cash flow. My wife and I, we had always a big challenge in February, and we couldn't work out initially why every year in February we were running out of money when we had more months than money. I like jokes. You know, it happened that all the yearly invoices, insurances, rates, car payments were due in February. So looking at what does our cash flow look like during the year for every month is also an important pointer for how we're going. And if we've got more cash going out than coming in, that's a problem. You guessed it. And we better know now. All right, enough. What's the end goal? That's the big question. Are you after choices in retirement? Are you after leaving a legacy? Or are you after financial independence? Because quite frankly, the shackles of financial dependence are not good, don't provide for good life. So to change that, we need to do something, and that is specific intent. All right, so what do? We do develop a customized, as far as we're concerned, multi-property strategy. If you want to have choices in retirement, if you want to have financial independence or leaving a legacy, you don't do that with one property. You need to establish a portfolio. Yes, we all start off with one, and we'll go through the system. I will make absolutely clear that it is no rocket science. Anybody that can get to the first investment property can get to 3, 5, or more. This is what our system is all about. And at the end of the webinar, I will offer you a free discovery call where we can talk about where are you at, where do you want to go, and what's the best way to get there. But that is later. So, strategy. There are two big trains of thought in the property investment arena. One is yield, so that's rental income, to buy property investment for rental income, or to buy property investment for capital gain, for increase in value. Now, it's really important to understand those two strategies and why one would use one, the other, or a balance. So I want to spend a bit of time to discuss that, because there's a lot of things that a lot of people don't quite understand the nuances. So the rental income, to go for yield, for rental returns, for high rental returns, is what I call the short-term money. It is the weekly or monthly cash flow that we need to get in to sustain our investment. In an ideal world, the property investment rent covers all the expenses. So if the rent comes in monthly and I have monthly bills, I can offset one against the other. So that's the short term. It provides for the lifestyle and the cash flow. It's not much good if you were only to get paid at the end of the year when you've got running bills during the year. So, and again, we want to ideally get to a property investment that pays completely for itself so that we can live the lifestyle that we've lived before the investment and not have any influence on our lifestyle. Now, that is where one of the biggest challenges in the property investment world is happening. People tell you, yeah, but you can do negative gearing, you can write off tax. Yes, that is great. And it should only be the bonus. It should only be the icing on the cake. Because if you do an investment for the tax refund, give it to me. Because you're getting 32.5 cents in a dollar. How many times would you like to give me $1 and I give you 32.5 cents? It doesn't make any sense. Worst of all, it is of your after-tax monies. So you reduce your lifestyle. This is the big thing. This is the big reason why over 80%, over 90% of property investors have only one property investment. Because they get stuck, they find out that they need to pay $500 or more for their investment property in the hope of capital gains. I'm getting carried away. Sorry, I love what I do. Okay. We need the short-term money, we need the rental yield for our financing. If you have big capital losses, if you have big cash flow losses, if you have a negative geared property, the banks will not like that very much because the servicing of the loan will be very difficult. Okay, and it is, of course, the small money, because even if you have $100 positive income per month, that's only $1,200 per year. If a property of, let's say, $500,000 only goes up 5%, that's $25,000. It's not hard to see that the rental income, the yield, is the small money. So let's have a look at growth. Growth is the long-term money. It's the money that increases, the property increases in value over time, and that does take time. So it's a long-term money. This is also where the lifestyle comes from. Again, I go back to my example. If a property increases by 5% on the 500,000, that's 25,000. After 4 years, you should be sitting on $100,000 worth of equity. It's not hard to see that through that you can increase the assets, and then ultimately at the end stage, at the exit strategy, or as an exit strategy, sell some or all of the properties and retire your debt. More to the exit strategy later. Refinancing on portfolio is very much driven by growth. If we have, let's go back to the example, the 4 years times 25,000 increase in value, any bank will give you 80% of that, and you have the deposit for the next home. This is the way to build a portfolio. And then, of course, it is the big money versus the, in my example, $1,200 a year for rental, positive cash flow, and in my example, $25,000 per year in capital gains. No question which one is the bigger one. Makes sense. I do hope so. If not, remember, put my questions into the chat. Okay, so let's have a look at area selection. Again, it goes back to a personalized strategy. The reason being is some people are more risk averse, some people are more risk friendly. Some people want to go and lean a bit heavier on capital gains and can take a bit of a negative. We personally prefer a balanced approach, but there is no one shoe fits all. That's why we call ourselves property strategists. We have a personal discussion, one-on-one. We can do that on the net. That's what the discovery session is all about. And that allows us to start developing a personal discussion and a personal strategy. We would like to know more about you than your name? What drives you? Because ultimately that's what is going to create success in life, in business, in the job, in property investment as well. There is, of course, any area starts off with the offsite research. The statistics, the usual indicators that tell us whether an area qualifies. So let's go for some. A great indicator is rental vacancy. Generally speaking, rental vacancy between 3.5% to 4.5% is considered to be a balanced market. Well, we want to stack the cards in our favor, in the favor of the landlord. So we're looking for areas that have less than 3.5% rental vacancy. Let's talk about cash flow. At the current interest rates, and by the way, surprise, surprise, 0.5% increase today by the RBA. Interesting. That's a whole different subject that I'm not going to go into now. At the current interest rates, 4.5% to 5% rental yield, rental income. So that's purchase price, percentage of rent. 5% will certainly cover all expenses in the areas where we do business. Now, allow me to say something about the areas that we do business. We select our areas very carefully. Again, only what's good enough for my wife and myself is good enough for our team. So we select 3 to 5 areas per year, which fulfill our criteria of a balanced approach, 5% rental yield, of rental vacancy less than 3.5%, and a whole string of others. So that's all the research that is done off-site. Now, that's where a lot of marketing companies and a lot of theorists, allow me to call them, start their investment and base their decisions on that. Wrong, in my books. And I stand by that. 20 years of experience have showed me that it is really, really important to do on-site research. You got to go to the area or send somebody that you trust. This is why we are in the areas that we invest in 3 to 4 times a year minimum. You got to touch it, feel it, smell it, as I call it. You got to be in the market to be in the market. I need to know who is who in the zoo to really get the last dollar out of our investments, to get the best investment. I need to understand which suburb in a town is the better one. I need to understand which end of the street is the better one. I need to know which side of the street is the better one. That makes the difference of a good investment versus a great investment. That makes the difference not so much in rental yield, but certainly in capital gains. Again, it makes sense, doesn't it? When you're in the right end of town, on the right street, at the right end of the street, on the right side of the street, that's a more desirable property, a property that will increase in value more. So, how do we optimize? Well, again, no rocket science. Why both growth and yield? Simple, because we need to have the balance between the short-term money that needs to be high enough for the property to pay for itself, ideally. That's our benchmark. Because we want to have people being able to continue with their normal life. And then we look for the biggest capital gains, for the biggest increase in value that we can find. So, personalized strategy, I've talked about that. We have a 7-step success system that goes through, as I said, 7 steps, surprise, surprise. And that system includes what we call financial intelligence. So to know about the basis that we come from, to know about what is my assets, my liabilities, what do I owe, what do I own. This is part of our system. We want to educate our clients. We want to educate our team, because if we all grow, we can all do better deals in future. And this is what Property Friends is about. And this is what I suggest property investment should be about. It's a long-term strategy. I can get on my high horse, but I won't. I'll try not to. Forgive me. Yeah. So you really want to look for a predictable and risk mitigated system. Now, we've built our system up over 20 years and we're fine-tuning it constantly. Ask yourself, are you running a hobby or a business? Can I suggest that, as Warren Buffett says, for as long as you can't keep your emotions in check, you can't keep your money in check. So be unemotional. Run property investment as a business. I don't need to buy as a professional investor in the suburb next door to where I live. I don't need to go and check on the lawns. That is the task and the responsibility of the rental manager. That's their specialized area. I do what I do in my specialized area. So suggestion is run it as a business. Delegate, but don't abrogate. Surround yourself with great advisors, but know enough about their field of expertise to run the advisor, to check on the advisor. Ask enough questions. Don't abrogate. There are phases in investment, and that's how you can optimize. There's generally talk about a 7 to 10 year cycle in property where the S-curve goes up and then flattens out. Of course, it is best if you can find a market that is just on the cusp of rising. Naturally. And that's what we and everybody else is trying to do. But ultimately, it is about time in the market, not timing the market. Because the longer time you spend in the market, the more your capital gains is going to be. Effectively, time heals all wounds in property investment. So that's probably as much as I want to say about optimization. So the predictable and risk mitigated outcome is what I love about property investment, because it is fairly predictable and you can risk mitigate very, very highly. And you have control with house and land packages, which is what we do. I can go more into why we do that. There is a lot of science behind that. That does make a hell of a difference. I'm just getting a question here. How much difference does optimization make? In absolute figures, that's pretty hard to quantify. But I would suggest to you that it can easily make a difference of 5% of value of the property. Think about it yourself. If you find an area that performs better than other areas, there's easily 2, 3, 5 more % at times in that alone. And then to come up with the right design in the right area for the right house, for the right tenant profile. That is what is making the difference between a specialist, between somebody who organizes this as a business and somebody who runs it as a hobby, where I just buy next door to where I live or in the next suburb, and that's it. As a professional investor, I want to squeeze the last dollar. I want to get my optimum gain. That makes sense. I hope I've answered that question. Great question, by the way. Acceleration. How do we accelerate this whole thing? I know this is hard to read and it's not meant to be going through everything there. This is a model of a 10-year journey through property investment, where every time when you've got the equity to buy the next property, you go and buy another property. Now, it is a model. Will life happen like that? No, no way, and never. It is variances happen all the time. But we have proven that this can be done many times over. So after 10 years, you would end up with $3 million equity and 13 properties. By the way, we have helped 3 families to do that in less than 7 years. So what I'm talking about here is, again, not off the cuff. It is stuff that we've done. So let's go into a case study. I wanted to keep this to 45 minutes, and I want to keep time for questions. By the way, do we have any questions up to here before we go into the case study? Feel free to open your microphones. If you've got a question now on what we've covered so far, by all means. Gives me time to have a bit of a drink. No questions on the chat. Don't be shy. Feel free. Otherwise, I keep moving on. Okay. There's Reggie. Yeah, please go ahead.
Some people suggest that income or yield is more important than growth. What is your view on that?
Great question. Thank you. I believe in balance. Yes, I can go for the security of the income. In the example that we've spoken before, the $1,200 worth of monthly income, $1,200 per year, the $100 of monthly income through a really high rental yield, really high rental rate, is great money and gives you security. But it is the small money. So our view on it is get as much of the rental income of the small money that you need to have balance, to have the property pay for itself. But the upside is in the big money, is in the capital gain. So that's where it makes sense to go for balance. I hope that has answered that. It is one of the biggest, of the most misunderstood things in property investment. So if you've got questions on that, by all means, put them in the chat, or we'll cover them later on. All right, let's go through a real world case study. I have spoken about the model, and this is again hard to read, and I've changed the names, but here are 2 families where the first one has made in about 3 years $309,500, and their rental yield is at 7.43% now. So that's not bad at all. I don't know too many people that can make $309,000 in 3 years on the side and then have 7.43% rental income, which is definitely positive cash flow. And that is what comes in over time. The second family, and yes, they did have their tongue hanging out because the work is done by the guys. And yes, they had more equity, more funds to start off with. So they started off with 3 properties in the very first beginning, whilst the other couple went with 1 property. But they ended up after about 3 years with $602,000. Now that is making a serious dent in retirement income, in financial independence, in choices, and in leaving a legacy. So I hope that gets the picture clearer why you should go for a multi-property strategy. And there's a hell of a difference between setting yourself up long-term with one property. That's easy. But the financing for the 5th property or for the 10th property, that's where it gets harder. So we might as well start off with one, but put ourselves in the best position to get to the end goal of multi-properties. How many? That's up to you. Personalized strategy. Okay, I'm getting on my high horse again. Sorry. All right. So let's look at a real-term case study. We're talking about this house. It was purchased in 2018. House and land was purchased at $360,000. This is in Midway Point in Tasmania. And we picked it just at the right time. Beautiful. The anticipated rent was $390 per week, or a rental yield of 5.6%. The vacancy rate at the time was about 3%. So that is where we started off with. That ticked the boxes. There was anticipation of good value increases. And by the way, don't let anybody tell you that they can guarantee value increases. It's the same like a rental guarantee. Nobody can predict that, and nobody can say with 100% certainty that this is going to come through. So people build risk margins into their prices. I don't think that's right. So, but you do your best research to see whether the indicators tell you there will be capital gains. And there was. So this is what happened. Today, the value is $550,000, actually getting close to $600,000 now. The actual rent is $530 per week, which is a rental yield of 7.1%. Again, positive cash flow after 4 years, 3.5 years. So this is how property investment works best. Can you see that we can take from the 550 to 360 is 190,000. Banks will usually lend easily 80% against that. So call that 170,000, call it 150,000, doesn't matter. So with that, I can certainly buy one, if not two, additional properties and use that money as the equity and get bank financing on the other, on the new ones. If my lending criteria is right, if my rental yield is high enough for the existing properties. Otherwise, you can't service. See, this whole thing is a interconnected, self-regulating circuit. And if you set it up right, it will run smoothly. The wheel will turn nicely. But if you get it wrong in the first one, and you go for a property that has, let's say, Melbourne or Sydney, in a city, $800 to $1,000, sorry, 800 to $1 million purchase price, 2.5%, 3% rental yield. You are paying between $500 to $1,000 per month of your after-tax money in negative gearing. How many times can you do that? With one? Maybe. With two? With three? Four? This is where it gets impossible. And the lending calculators of the banks won't give you any money. This is why people get stuck. So, yeah, balance again. And so with those sort of figures, you can definitely go and have some fun and build your portfolio. Allow me to play a testimonial from David and Daniel's story. They have been long-term investors with us. Now, let me just see whether I have ticked the right boxes here on the share. No, I need to turn this on and turn this on and that on. So now you should be able to hear it.
Would I recommend Property Friends? I wouldn't buy a property any other way.
We love Property Friends. What I love about Property Friends is that all the information is there. That David, he's the figures guy, and he knows that he can not only use Uber and Ula's expertise and their information that they have. They've got more information than we could possibly want. They do an enormous amount of research, which makes him comfortable, and happy husband, happy life. But what I really like is the community that Property Friends has built. There are numerous numbers. There's a whole community of us that are buying property for investment all across Australia. And we can get together once a month. We sit down and we talk about who we've got insurance with, how we're organising our loans, who's doing our paperwork in terms of mortgage things. And we're very comfortable because it's our investment, it's our property, but it's backed by the experience and it's backed by the expertise and it's backed by the passion that Uva and Ula have for their customers and their clients. We're very happy Property Friends customers and clients.
Indeed we are.
Really proud about that testimonial, and you can find more of those on our website. As you can imagine, it's not easy to get people to talk about what they do financially on a video, and many of our clients have, which we are very honored about. Okay, let's talk about the game plan. All right. If I have left any doubt, it's all about you. It's not about what I can do. It's not about what we can do. Yes, we have got the experience. Yes, I can do deals. But it's all about where are you at, where do you want to go, and what's the best way to get there. Very simple. It doesn't need to be complicated. Get the information, let's do the due diligence, and have the right team around you. Really, really crucial. As the old adage goes, it's hard to soar like an eagle when you're surrounded by turkeys. Get the right advisors. And by the way, on that note, we have what we call strategic alliance partners that are specialists in their fields. And why do we work with them? Why do we refer them? Because they're specialists in their fields and they've over the years proven to be doing the right thing and things right. We don't get a cent out of any referrals. There is not a dollar that you don't know about. And that's just the way that we want it. So, yeah, just see, I've got a question here. Have you got access to a mortgage broker? Yes, we can refer any and every specialist that you will ever need. Why? Because we are in the game ourselves. We're doing it ourselves. We need those specialists ourselves. And I'd rather go as a team and say to a mortgage broker, look, we will have, let's call it 10, 20 deals for the year going through. Would you like to be our strategic alliance partner? Do you think he or she is going to look after our group better? You bet your sweet pippy they will. This is where the group strength comes in. And that refers to everything, to the rental manager, to the depreciation schedules that we get at a magnificent price, whatever. Yeah, so rest assured we have access to all advisors that you will ever need. So the right team is really important. Where are you at? I've hammered that enough. And what's the end goal? That's what it's all about. And then we want to develop the customized multi-property long-term strategy. as I alluded to, at the end, I'll put to, or maybe, sorry, Lenny, if you can put through the link for the discovery call. Sorry, just need to have a glass of water. You can book in free of charge for a 30 minutes discovery call where we'll just have a chat and see exactly those 3 points. Where you're at, where do you want to go, and how to get there. You'll find the link in a minute. Lenny will put it up. Okay, so as to the game plan, we want to go for balance between yield and growth with emphasis on the growth. Ideally, 5, better 10 years strategy. There is no get rich quick, forget it. There is getting financially secure in a safe and risk mitigated way, because the turtle wins the race, not the hare. Again, I like Warren Buffett. He's claimed to have said, return of my money is more important than return on my money. You don't want to lose. So, best 3+ property strategy. I generally say go for 5. Then you can, as the end game, sell 2, take the money, retire the debt on the original 3, and you have rental income on 3 properties. The average property has got $25,000. And if you have an additional $75,000 in retirement, that is a very nice buffer to live off, for sure. The risk versus result is second to none in property. And again, that's something that we look at in our strategy session. What is the right strategy? Depends on where you're at, depends on cash flow, depends on your goal, depends on your risk profile, and so on and so forth. Everyone is different. And that's why we offer that 30 minutes discovery call. The link is here again, it's in the chat. By all means, book in. No obligations, we'll just have a relaxed chat. All right, I have already gone 4 minutes over. Naughty, naughty. I just get excited about that stuff. I love what I do, and I like to think I do it well, and for the right reasons. All right, let's go to some questions. Feel free to open the microphones, or if you just want to put it in the chat. Lenny, did we have any questions in between?
Yes, I am actually receiving questions in the chat box, and I am actually accidentally putting it in the chat as well. So, yep, we have one question from Mr. Reggie. He asked, what is the exit strategy? Are you suggesting selling everything?
Okay, another, geez, you're hitting me hard today. Another very good question. My short answer to that is it depends on your risk profile, how many properties you've got, what is the equity, and on so on and so forth. So essentially there's two points where the pendulum can swing. One is sell everything, take the capital gains, whatever that figure is, and live off that to supplement your income or for it to be your total income. The other end is a rising debt strategy. Let's say that I've got, and this is now just round figures, 5 properties at 500,000, so that's 2.5 mil, and each of those is only going up by 5%. So that's, what did we say, 500,000 by 5% is 25,000 per year, times 5 is 125,000. Now, some people argue the point that if I have a value increase of 125,000, there's everything right with taking up to $75,000 of that and increase my debt. So that's why they call it the rising debt strategy, and live off that, because I maintain the other assets and I maintain the capital growth on the other assets. Now, both strategies have got their pros and cons. And guess what? It depends on the person. It's a personal choice. It depends on where you're at the time. And we can certainly help you and guide you through that process. You will know your truth. Because one of the biggest things that we want to do is make sure that you're comfortable. And you will do what you are comfortable with. That's the biggest aim that we've got. I've got here another one. What happens if you find it difficult to rent? Okay, another great question. Typically that does not happen, because that is one of the strongest indicators that we look for, a very tight rental vacancy. The areas that we're investing in at the moment currently have under 1% rental vacancy. So the tenants are screaming for properties. But let's assume that there is a 4.5% rental vacancy figure. Well, you need to address that through having the right value on your property for rent. And of course, you can give also incentives of 3rd month free, or 2 weeks free in 6 months. You know, we have given incentives to tenants of putting a food basket, welcome basket into the property, which I think is a very nice gesture. But typically we find that that's not an issue for us, and we don't need to do anything. It gets into desperation mode usually when you need to go there. I hope that answers that. Anybody got any questions? Feel free to open the microphones, or have we got other questions, Lenny?
Okay, hold on, please. Okay.
What are your views about lender's mortgage insurance? Okay. So lender's mortgage insurance, or LMI, is an insurance for the banks, not for the property owner. Let's be clear about that. It safeguards the banks. If we, as an investor, cannot pay our mortgage, the bank has insurance for that. We still have the liability. So let's be clear about that. Typically, that kicks in at 80% and gets higher the more you go up the scale, up to 95%. I personally like to stay at 80% or below. 1, it gives me a safety buffer. 2, I hate spending money where I don't need to. And 3, it is easier to go for further lending on further properties when you have got an LVR, or loan to value ratio, of 80% or below. Having said that, we have just been through a time of great increases in value. Now, our own daughter bought a property at 90%, I believe. So she had to pay lender's mortgage insurance. However, and I said, go for it, darling, do it. The reason is, if you have to wait for your savings to accumulate for another 2 or 3 years, the market that way it was running was outrunning the savings that they could do. So if you can get in the market at a 90% LVR, loan to value ratio, 2 years earlier, in my view, do it. The reason is, if you buy the right property in the right area, you get the money through the capital gains. And it can happen that the market outruns you. So that's why so many of the young'uns have issues now to get into the property market. Any capital city, there's just about nothing to be had under 800,000. So that means a 640 mortgage. So that means $160,000 deposit at 80%. I don't know too many people that have that. Never mind too many young people that are starting out that have that. So then if you can reduce that to 80,000 and or go for an investment that is only 500,000 and now you reduce it to 50,000, that makes a difference. Make sense? I hope so. We are already about an hour's mark, so if we got any more questions, I can stay until 10 o'clock. That's I don't mind answering questions, but yeah, so that was okay. Anything else?
None in my chat box then.
Okay.
Okay.
I'll give you 30 seconds to review, and if we've got any questions from the panel, by all means. In the meantime, if you want a resource, I've written a book. It only took 5 years. There's the link for the people on the call. If you use the discount code ebook for success for the next 24 hours, you can get the book for $10. That's the PDF version. You can download it. I cover in there exactly the 7 strategies that you need to look at. Personally, I think it's a damn fine resource, but of course I'm biased. Okay, Lenny has put the details in the chat, so thanks for that, Lenny. Yeah, and definitely book in a strategy call. There's no risk, no cost, so what have you got to lose? We can have a chat and we can go from there. All right, I'm done. I've gone 15 minutes over, my apologies. I hope it was interesting for you. I hope you got some really good pointers, really good information. And let's have a chat. Thanks very much. Have a good one. Bye-bye.